Good morning. This is an attempt to record some information for Chapter 2 in Principles of Financial Accounting because of a snow day we're having. So let's just get started. We'll start with the very first thing. What are source documents, types of accounts, and what is a general ledger? In Chapter 1, we recorded transactions using a spreadsheet. We had assets on the left, followed by liabilities, and then the equity section of the accounts. In this chapter, we're going to learn a different way of recording things, and so we need to understand what's happening with these source documents. Okay, source documents are just generally bills that we might get from a vendor, bills we might send to a customer. They could be records of inventory, payroll time, all kinds of things, all different kinds of things. But each source document represents a transaction. Sometimes a transaction is between two accounts in my company. Doesn't involve another company, but a lot of times, or another person, and a lot of times, though, the transaction will involve another person or another entity of some kind. So the transaction occurs. A source document is usually created at that time. You analyze the transaction. You identify the elements of the transactions based on your understanding of the accounting equation. What elements are affected with this transaction? And then we record the transactions in a journal. Pay attention here. The first thing we do is we record the transactions in a journal. We have to do that first, and that solidifies our understanding of what we've experienced, what the transaction was. And then we take that information in the journal and post it in a general ledger. Okay, the general ledger, all that is a holding area for all my different accounts, and we'll talk about accounts in just a second. After we get everything posted in the general ledger, we can use the balances of those accounts to create financial statements, just like we did from our wide spreadsheet. You take the bottom number on each account in that spreadsheet. That's the balance at that point, and you can use those balances to create your financial statements. We don't have spreadsheets now. We have individual accounts. Here's an idea of what the accounts might be. Think of the general ledger as a big filing cabinet, and we are putting in that cabinet each file folder, and each folder is an account. Look at the accounts for assets. These are some you've already seen before. Cash, accounts receivable, which is money someone owes me. Generally, a customer owes me money because I sold them something on account or on credit. Notes receivable, which we mentioned in class. Notes receivables and notes payables represent credit, either someone owing me or me owing someone else. That is backed up by a contract stating the amount of interest, when it's going to be paid, how it's going to be paid, etc. Inventory is stuff I own, an asset that I intend to sell to someone else to make money. This is my business. So when I have inventory, if I sell computers, then computers are my inventory. If I'm a stockbroker, computers are not my inventory. If I sell shoes, then shoes are my inventory. All right, prepaid accounts. These are accounts where I have paid ahead. Think of insurance. A lot of times you'll pay an insurance premium at the beginning of the year for the whole year, or sometimes at the beginning of a quarter. We used to pay them, almost all our insurance was paid annually. Supplies, these are just incidental things that we're going to use in our business over the course of some time, maybe a few months, and we record those as an asset until they are used, and we'll talk about that in the next chapter. Equipment, these are long-term assets. These are assets we expect to last for several years. If you are a grading company building highways like we were, then bulldozers and backhoes and vehicles and stuff were our assets. Buildings, another long-term asset, and land, another long-term asset. Liabilities, accounts payable, we know what that is. People that we owe money to, we're their customer. They're our vendor. They sold us something on account, on credit. Notes payable, we just talked about that a second ago. Accrued liabilities, these are liabilities that we have incurred, but there's not a document relating to it. For example, maybe our power bill doesn't come till the 5th of the month, and so on December the 31st, when I'm making my financial statements up, I have to accrue for that power bill using an estimate or some other method to figure out how much I owe for that power bill. Interest, if I have a loan that I owe somebody, a note payable, then as time passes, that interest is growing, although there may not be a paper trail, a source document we talked about showing that, so I have to accrue that liability. Unearned revenue, we mentioned recently. Unearned revenue, some books call it deferred revenue, but unearned revenue is money that people have paid me for things that I haven't done yet. For example, I always use the yard mowing or lawn mowing business. If someone pays me at the beginning of the year or beginning of the summer, we'll say they're going to be on vacation for a month, and they pay me ahead of time for 4 times to mow their yard, I'm going to put that in cash. My cash is going to increase, but I can't put it in revenue because I haven't earned it yet. I put it in unearned revenue, a liability. Then as I mow the yards, the first time I mow the yard, I could put 1/4 of it in revenues. The second time I could take another 1/4. The third time another 1/4, and by the 4th time I would take the last bit of the unearned revenue and put it into revenues. That would deplete the liability, so I don't owe him any more money, and I've shown it on my earnings. If I didn't mow the yard, if he came back after vacation and his yard was waist high, then I would have to pay him that money back. I can't record it as revenue, so that's why it's a liability. If I don't complete my part of the agreement, then I have to return the money to him. Equity accounts, we've talked about these. There's common stock, which is so far, everything we've talked about so far, including common stock, those are all permanent accounts. Their balances remain from period to period to period. The other equity accounts, dividends, revenues, and expenses, we know about those. Dividends represents earnings that I'm distributing or returning to the stockholders. The revenues represent money that I've earned by selling something, selling a service or selling a product, and expenses are the costs of selling those things, doing that business. There's one more account that we don't have here, and that's retained earnings, and basically you take revenues, expenses, and dividends, and at the end of the period you zero those out and push that money into retained earnings, and retained earnings then becomes a cumulative account for all the earnings that we've earned, the net income, revenues minus expenses, less any dividends we've returned to the stockholders over the life of the company. As you can see, this is page 46 in the book, and it describes the different accounts. If you have a question, this is a really good resource. The cash, what it is, accounts receivable, what it is, notes receivable, prepaid accounts, etc. Just like I've described, these are all the different ways that they describe them. And it mentions here's a good description of equity account, common stock minus dividends plus revenues minus expenses. So common stock is paid in capital or contributed capital. These are owner distributions. Dividends are revenues, is things we've earned, amounts we've earned, and expenses are amounts that we had to pay, expenses that we incurred to earn our revenues. Okay, the ledger, and we're going to be talking about the general ledger most of the time. There are subsidiary ledgers that include just a few accounts, or sometimes just the detail of one account, but the general ledger includes all the accounts that we have. If we have a 3-digit account number system, then the asset accounts would start with 1. No matter how many digits there are, the first number is going to be determined by what kind of an account it is. So asset accounts always start with 1. Liability accounts start with 2. Equity accounts, that's going to be the common stock, retained earnings, and dividends, are going to start with 3. Revenue accounts are going to start with 4. Remember, they are in the equity section, but they have their own set of accounts. And the expense accounts start with something above 4. They say 5 and 6, but it could be, this is a typical chart of accounts. It could be 5, 6, 7, 8, 9. If you can look at any account, and if you know the account number, then you know what it is: asset, liability, equity, revenue, or expense. And if you are creating a chart of accounts, if you know what that account is, then you know how to number it. This is a partial chart of accounts for the company that we're going to be working with in this chapter and later chapters. Fast forward, see that cash is 101, accounts receivable 106, supplies 126. As you can see, I won't read all these to you. Notice 1s are assets, 2s are liabilities, 3s are common stock, retained earnings, and dividends, 4s are revenues, and then they have 6s as their expenses. One thing I would mention here, you see how they're not in order. They're in order, but they're not consecutive. We've left a little space for some accounts, and that's a common practice. It's when you're setting up your chart of accounts, you don't want to put accounts as right like 101, 102, 103, because we have equipment down here, and that's a long-term asset. We may want to put a current or short-term asset in there. Maybe we get another like prepaid insurance. Maybe we want to put prepaid taxes in there, so we need some room to put those numbers in there. We have accounts payable and unearned revenue. We may want to put notes payable or other things in here in the liability. Same thing with expenses. We're always adding expense accounts, so it's a good idea to leave plenty of room in the expense accounts. This is a pretty cool little thing to remember, and we talked about unearned revenue before. Again, you might see it in other books as deferred revenue. But not just professional teams, but college teams, even high school teams might have season tickets. So if a basketball team sells a season ticket for the next season in, say, July, then that money they receive the money, but they haven't played any games yet. So every time they play a game that ticket refers to, usually home games, then they would take that percentage of the money and take it out of unearned revenue and put it into the ticket revenue. Okay, so let's look at classifying the accounts here. You can do that. Just play the little video and learn how to classify each of the accounts. This is a really good little practice to do. The need to knows are really good things to do at the end of each little section to make sure you understand what you're doing. I would also go to the back of the chapter and look at the quick quick questions there, and maybe some of the exercises and problems that deal with area C1 or learning objective C1, and see if you can do those. Okay, now we're on the second section. We're in learning objective, or section C2. We're going to talk about T accounts, debits and credits, and what the normal balance is. I urge you to pay attention to this and really get comfortable with the normal balance of these accounts. It's going to be critical that you understand that. So before, we've had like a column, and we'd have cash with a positive and a negative and a positive and a negative and a positive and a negative. We don't generally do positives and negatives in an account. What we do is we have an account with two sides, and one side of the account shows an increase to that account and the other side shows a decrease. It's much easier to follow that way. This is called a T account. As you can see, the name of the account is at the top. The left side is the debit, and all that's all that debit means. It means the left side of the account. The credit means the right side of the account, and whether it's an increase or a decrease depends on which side of the equation it's on. Cash and other assets are on the left side of the accounting equation, and so they increase with debit or left-sided entries, and they decrease with credit or right-sided entries. So if somebody invested $10,000 cash in the business and then got common stock, cash would have an entry of $10,000 on the left side showing that it increased. And then the other account that would be affected would be common stock. Well, common stock is on the right side of the equation, and since it's on the right side of the equation, it's increased with a credit or right-sided entry. And so we would put $10,000 on the left side of that cash account and $10,000 on the right side or credit side of the common stock account. That way we're in balance. The left side now is in balance with the right side. We can just look at that one entry and tell that that's happened. So understanding which side of each account is increasing that account and which side is decreasing that account is critical. Okay, double entry bookkeeping, and that's what we're dealing with here. Whenever you make a transaction, and we talked about this in chapter 1 with the spreadsheet. Every time you make record a transaction, you have to record it in at least 2 accounts, with at least one debit entry and one credit entry, and the total amount of the debits has to equal the total amount of the credits. In a lot of entries, it's going to be just 2 accounts, like cash and common stock. Or if I pay an expense, you would decrease cash with a credit, and you would put the debit in the expense account. So it would still be the left side and the right side would be equal. Here is critical that you understand this. Assets are increased with debits and decreased with credits. Liabilities are just the opposite. They are increased with credits. They're on the right side of the equation, so their increases are on the right side of the T account, and their decreases are on the debit side of the T account. Equity accounts are the same, but it's a little different. Credits increase debit account. Credits increase equity accounts, and debits decrease equity accounts. But let me show you something. Back to this. Remember, liabilities, all of these increase the right side of the equation, right? So all these are going to be increased on the right or credit side of the account and decreased on the debit side of the account. Common stock and revenues follow the same pattern. They increase equity accounts, so they would be increased on the credit side, decreased on the debit side. They increased on the right, decreased on the left. However, dividends and expenses, since they actually reduce equity, then these would be debited and credited the opposite way. For example, think about what's happening. If I pay a dividend, I'm going to decrease cash, which would be a credit entry or on the right side. So I need, say I pay $1,000 in dividends, so I've got $1,000 on the right side of my entry. Dividends would be increased on the left side or debit side of the entry, opposite of the other equity accounts. So whenever you increase a dividend, as we know, dividends are subtracted from equity, so we're going to increase dividends with a debit entry. Cash would be credited for $1,000, dividends would be debited for $1,000. Cash would receive the entry on the right side, dividends would receive it on the left side. If we paid an expense the same way, expenses are increased on the debit or left side and and decreased on the credit or right side. Okay, so here we go. One more thing. Whichever side of the account is the increased side, that is the normal balance of that account. So assets are increased by debits, and they have a normal debit balance. Normal balance is the same as where the increases are. Liabilities and common stock and revenues are all increased on the credit side, as you can see here, and that is their normal balance. Dividends and expenses, as we know, they decrease equity, so they have a balance. They're increased on the left side, debit side, and their normal balance is on the debit or left side. Please learn this. Please understand this and get this locked into your mind so you're not confused about this at all. This will make your life so much easier. As it says here in the book, credits to common stock and revenues increase equity. Debits to dividends and expense decrease equity. Equity is increased by credits, decreased by debits. So anything that is going to be decreasing that equity would be increased with a debit entry over here. So here is an example of a T account for their cash account. For fast forward, we went through some of these in chapter 1. We got an investment from the owner, and this is only the cash account. It's not showing the other accounts that were there, but each account just records the transactions in that one account. So the first thing that happened, we received an investment in cash and gave up common stock, or issued common stock. We purchased supplies for cash. We purchased equipment for cash. We paid rent with cash. We received revenues from consulting, and then here we collected money that we had already posted in accounts payable, already recorded in accounts payable. We paid salaries. We paid on accounts payable. We had bought something on account. We paid $900 on accounts payable, and then we paid a cash dividend. And you'll notice here the balance is on the debit side, the left side of the equation, left side of the account, since it's an asset. So you are rarely going to see an asset with a balance on the credit or right side. You're just not going to see it. In this book, I do not think that happens at all. So you can, if you know that assets have a debit balance, you'll be far ahead of the game when you're doing problems. Let's scroll down and look at this little problem, and they're asking us to identify the normal balance of these accounts. Well, if you know the account, if you understand what the account is, then you will understand whether it's a debit or a credit balance. For example, prepaid rent. In your mind, think, what is that? It's an asset. I have prepaid something. I have paid for something I'm going to be able to use up later. I paid for rent that I'm going to be able to use for the next several months. So, for example, rent is $1,000 a month. I pay $3,000 up front. So I'm going to put that into prepaid rent. As the months expire, as the months progress, then I can take it out of prepaid rent and put it into rent expense. So this is an asset. It has a debit balance. So the normal balance of this account is a debit. Common stock is an equity account. Normal balance is a credit. Note receivable, an asset again. That would be a debit balance. Accounts payable, that is a liability. Credit balance. Accounts receivable, that's an asset. Debit balance, left-sided balance. Equipment, another asset. That is going to be a debit balance, left-sided balance. Interest payable, anytime you see payable, that's a liability. And so this is going to be a credit balance. Unearned revenue is not a revenue, it is a liability, and it'll have a credit balance. Land, asset, debit balance. Prepaid insurance, just like prepaid rent, an asset with a debit balance. Dividends, Remember, dividends go against the equity balances, so it has a debit balance, and utilities expense again goes against the equity. It reduces equity, so it has a debit balance. If you should be able to just knock these off as quickly as I did. All right, we've been through this system of accounts. We've talked about source documents, types of accounts, and what the general ledger is. We've talked about T accounts, debits and credits, and normal balances, and we did this little need-to-know thing. By the way, I'm just going to mention T accounts. Please start using those in your on paper as you're solving problems. Accountants will use T accounts for the rest of their lives. And even if you're not an accountant, if you're in business or if you're in healthcare management or something like that, if you understand the accounting system, you'll be using T accounts to understand transactions and to map them out and to make sense of them. T accounts, get used to those. Use them all the time. Now we're going to get to the meat of this chapter, recording transactions. We're going to talk about journalizing and posting transactions, and we're going to have some examples of that. So this is the nitty-gritty. Go take a quick sip of water and settle down for with a pen and paper and take good notes. As I said before, when we record a transaction, we enter it in a journal. So here we have the source documents. We analyze each transaction based on the accounting equation, and then we record it in a journal. And the journal, we use the general journal here, but there are also some special journals, and I'll talk about those too sometime later. But the general journal is where we record things. This is called the Book of Original Entry. Up until now, things are just paperwork or even electronic things, or maybe even nothing, like an accrual. Like I said, we have to accrue an expense. So we might, all those things don't really make any sense. They're just out in the world, and we capture them in the general journal, and then we post it from the journal to each account. Think of the T accounts in the general ledger or any ledger. They look a little different than a T account, but it's basically the same thing. So we identify the transactions, we analyze those using the equation, we record the journal entry, and we post to the ledger. Notice the journal here, we have two columns for the amounts. The left column, guess what that is? That's for debit entries. The right side is for credit entries. Cash is increased by $30,000. Common stock is also increased. Is increased by $30,000. Cash on the left, common stock on the right. Both accounts increased, and we are in balance here. Notice that the account is written in full. We don't abbreviate in the general journal, and anything that is going to have a credit entry is going to be indented a little bit. Now, I indented more than this. They didn't indent very much. The other thing that the book doesn't do a good job of is you need to have a description under here and then skip a line. You always skip a line between your journal entries, but you also need to make a description. And here I would the simplest thing, I would say received cash for common stock. Here I bought supplies, so supplies are debited, increased. Cash is credited, decreased, and I would have a description, purchase supplies for cash. Even though it looks simple, you need to make that description, then skip a line. Here we go. You can see they've indented very well. Please get used to that. Indent a lot. Some students really think they're saving the world by not indenting. Please indent. Indent plenty, because you want somebody to come along and see this later on and understand it immediately. So I can look at this and I know cash was debited, common stock is credited, I know the amounts. Here's a description if I don't understand this for any reason, and here's a really good date. So you have the date at the beginning of the page. Listen to this. The date at the beginning of the page always includes the year, the month, and the day. After that, you can use the month and day. Sometimes some companies, and this is the way I was trained, you would only have to put the day. So as long as the year and the month don't change, all I can do, I can just put the day there. I'm happy with that because that's the way I learned. But in this book, you'll see the transactions are listed with the month and day over here to the left after you begin the page. So at the top of the page, you'll put the year, month, and day. And then if nothing changes, if the month or the year doesn't change, then you just keep it like that. So this is a great thing to keep in mind. There are six things that make a transaction correct. One is the date has to be correct. The debit entries come first, and then of course the debit amounts. The credit entries come next, and of course the credit amounts, and then the description. And then skip a line. I guess there's 7 things, but I think of almost everybody learns how to skip a line. Please do that. But all the debit entries, if this person had invested cash and equipment, then I would put cash first, 15,000, say, and then I would put as another debit equipment, 15,000, and then I would finally indent and put common stock, 30,000. So all the debits come first, then the credits, then the description. So that's what you want. Date, debit entry, amount, credit entry, indented, amount, description, skip a line. You always want to skip a line. Make a good description. This is as important as anything else you do, the description, because you're going to record this, say, in January, and someone is going to come along at the end of the year or end of 6 months or next year sometime, and they're going to be auditing it for some reason. It could be your auditors, it could be your boss, it could be an internal auditor, it could be some agency from the government, wage and hour people, stuff like that. And whatever they're looking for, if it's not well described, you won't remember why you made an entry. They're not going to ask you about this entry. This entry is easy, but the entry they're going to ask you about, you need to know. So always record a description. Always, 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 always. And I don't indent my descriptions. I push them way over here so that I have room. Anyway, this page, what page is this? Page 51. Great page to mark. All right. This is a good example of a general ledger account. You notice it's not a T account, but you don't have to put an explanation in the general ledger. The only time I put an explanation in the general ledger if it's something other than a normal transaction. So again, we have the full date at the beginning and then just the month, day, month, day, month, day. This column we're going to leave alone for a minute. But here is, this is just the cash account. You know, this gives the title and the account number, the date of the transaction, and it was a debit. So our balance now is $30,000, and the balance doesn't say debit or credit. It just says balance. You know it's a debit balance because it's the cash account. You just know that. If it was accounts payable, that would be a credit balance. But cash has a debit balance here. We have a $2,500 transaction that reduces cash where we bought some supplies. There's my new balance. Debits increase it. Credits decrease the balance. Here we bought equipment for $26,000, decreasing my balance to only $1,500 at this point. And then I performed some services and collected $4,200 immediately, and my new balance is $5,700. Please learn how to do this. I've posted some videos in Canvas to help you along with learning how to do how to record journal entries and post to the ledger. Posting journal entries, and that's what this PR says means posting reference. And so what you're in the journal, you see we have a PR label here and a PR column here in the ledger. So what you're going to do, if I post something to cash, I'm going to put the account number in this column. So cash is account number 101. So after I post this number to the ledger, I'd put a 101 there, and then I would put the page and the journal that this came from here in the general ledger, so I can trace back and forth. This is the general ledger, page 1. General ledger, it doesn't show the page number, but it is general ledger, page 1. And that is, if I look here in the general ledger and I see this entry and I have a question about it, I can go to page 1 of the general ledger and find that entry. I mean, general journal. Sorry, I can go to page 1 of the general journal and find it. If I go up here and I see 101 in the posting reference column, I know that's in account number 101 in the general ledger. So in the general journal, you put the account number. In the general ledger, you put the page and the journal. We're going to be doing mostly the general journal, but there are special journals that we'll talk about another time. The book doesn't spend a lot of time on them, but you need to know them. As it says, the heading of the balance column doesn't show whether it's debit or credit, and the account is assumed to have a normal balance. So cash, an asset, is going to have a normal credit balance. And it says here, unusual events can sometimes temporarily create an abnormal balance. An abnormal balance is where you're overdrawn at the bank, so you have negative cash. At that point, we would put parentheses around that column to show that, or that balance, to show that that balance is abnormal, or in this case, a credit balance. So here we go. Let's go back to the first step. The first steps we had up here. Let's make sure we understand. The step 1 is to analyze the transactions. Identify the transaction. Step 2 is to analyze the transaction. Step 3 is to record the journal entry. Step 4 is to post to the ledger. And I've got videos of all these things on YouTube, linked in Canvas. So we leave the posting reference column blank, both in the journal and until we post to the ledger. So in the journal, they're going to be blank until we post to the ledger. And the last thing I do in this line is I'm going to put the page number, and then I'm going to go quickly back to the journal and post the account number. And then I'm going to post to the common stock account, and I would find the common stock account. It's going to be a 300 account. Post that, it'll be a credit of $30,000, the date and everything, and then I would put G1 in that account, and then put number 301 or whatever that account number is in the journal. Posting journal entries, here they talk about it. When journal entries are posted to the ledger, the debits in the journal entries are transferred to the ledger accounts as debits, and credits are transferred as credits. All you have to do is take the number. It's a debit account, debit amount up here going to the cash account. I'm going to go to the cash account and put it in as a debit. Here was an entry that is a credit to the cash account. I'm going to go down and put it in the credit column of the cash account. In the ledger, you also have the entry date. Then you put in the posting reference column, you put the journal page. Like I said, the journal G and 1. If it's on page 2, it's G2. In my case, we put GJ. That's what we always use, GJ, general journal, or PJ for payroll journal, or whatever. This creates a link, as it says, between the ledger and the journal entry, and it'll be used for cross-referencing or tracing an amount from one record to another later on. Accounting software does the posting automatically, but you need to understand what's going on. If you don't understand that, you're going to be lost when it comes to entering in something in an electronic format. The electronic format will hide things from you if you don't understand what's going on, and you will not know how to find it. So you need to understand this manually before you can do it electronically. But the same thing is happening. You're going to record transactions in a journal of some kind and post to the ledger. So here you can see this whole thing being posted. We have a general journal entry on December the 1st of 2027. Cash is debited for $30,000. I'm going to go down to the general ledger account for cash, and I'm going to put the date in, $30,000 debit, and the balance now is $30,000. I'm going to update that balance every time. I'm going to put the page number in the journal in the posting reference column of the ledger, and in the posting reference column of the journal, I'm going to put the account number that it went to. Then the other account that's getting posted is common stock. It's account number 307. So I'm going to go find page number 307. I'm going to post it as a credit balance. There's the date, of course, a credit transaction, and now it has a credit balance. And I'm going to put the general journal page number and the ledger, and then in the journal I'm going to put the account number that it went to. And this is going to be the process all the way down. I encourage you never to skip when you're posting from the general journal to the general ledger. Don't say, I'm going to post all the cash entries. Don't do that. You will make mistakes that way. Just go post cash, then post common stock, then go to the next entry, post, record all the stuff, go to the next entry, post. Don't skip around. It will drive you crazy. This is interesting. The blockchain technology that's used for these cryptocurrencies and things, it's a really secure, at least now, technology. The ledger is constantly verified. It can't be changed without other people knowing about it. It's an interesting opportunity for us with accounting knowledge, as we help build those things, as we manage those things. We help others use those things. But if you're the guy who understands accounting, you're going to be the guy making decisions and managing things. Let's see here. Okay, again, step 1, identify the transaction. Step 2, analyze the transaction according to the accounting equation. Step 3, record the transaction. Step 4, post the entry. We're going to be using T accounts here, but remember, this is what the world is using, general ledger accounts. Some ledgers actually have a debit and a credit balance. So you have 4 columns over here. This is called a 3-column ledger account, which is pretty common, but you could have a balance that says debit or credit, so the balance will be in the right side or left side. Doesn't matter. Here we go. We received that $3,000 from Chaz Taylor in exchange for common stock. We analyze it. We realize that common stock is going up and also cash is going up. Liabilities aren't affected. We record it in the general journal, a debit to cash, $30,000, a credit to common stock for $30,000. We post the cash entry over here, and you notice we've identified that as transaction number 1, or the date, if there were really a date there. There should be, but there's not. And so this is a debit to cash, a credit to common stock. You can see the posting reference column here. We purchase supplies for cash. Supplies, if you analyze it, supplies went up, asset. Cash went down, asset. So supplies are going to be debited. Cash is going to be credited. Here it is, supplies, debit, cash, credit. And here's the posting, a debit of $2,500 to the supplies account. You see the account number here being entered on the journal, and the posting reference, this would be the date for a T account, but in the posting reference column you'd have G1, General Journal 1. $2,500 credit to cash is now posted to the cash account over here. Just as a aside, when I do T accounts, I don't put more than one number on a line. I would go down to the next line. You don't have to skip a line, but this would not be on the same line. Number 2 would be down below that, and then number 3 would be down below that, no matter which side it's on. The book doesn't do that. I've never seen a book do that, but it is much more clear in my mind. We purchased equipment for cash. Cash went down. That's a credit. Equipment went up. It's an asset, so that's a debit. Here you go. Equipment debited for $26,000. Posting reference. Cash went down by $26,000. Here's the posting reference, 101 and 3 here for the date. We purchased supplies on credit. In this case, supplies, an asset went up. Accounts payable, a liability, also went up. Liabilities are increased by credit. Assets are increased by debit. So supplies, debit, $7,100. And here you go in supplies. You can see that number 4 is being posted to the supplies account and the account number put in the journal. Accounts payable is credited, and the posting reference for the date is here in the T account, and the account number is in the journal. One thing I want you to notice is there is no balance in a T account. It's not showing up here yet, so we have to actually do some math to get the balance, but we can do that. What you would do is you would add the things on the debit side and the things on the credit side, subtract them. This is 30,000. This is obviously 28,500, and we would subtract them. 30,000 minus 28,500 is going to be $1,500. And that is you're going to put the balance on the side that has the most money in it. Well, 30,000 is bigger than 28,500, so you're going to have a balance of 1,500 on the debit side, a normal balance. You can see supplies also has a balance of 9,600, but it would be a debit balance. Accounts payable has a $7,100 credit balance. If you go forward here, we provided consulting services and collected $4,200, so cash went up and revenue went up. Debit cash, here is that entry. Credit revenue, here is that entry. So you can see number 5 being as a debit to the cash account, and number 5 being as a credit to the revenue account, increasing both accounts. And you can add these up and come up with a new balance. We paid $1,000 for rent. Cash went down and expenses went up, but equity is decreased by that. So we're going to debit rent expense. Remember, expense accounts are debited as they increase, which decreases equity. So rent expense is debited for $1,000. Account number 640 is entered in the posting reference column in the journal, and the date, or in this case entry number, is entered in the general ledger account. Cash is credited for $1,000, and here you can see it in the cash account with the posting references. All right, we paid expense of $700 for an employee's salary. We're going to credit cash. We're going to debit the salary as expense. So here we go. Salary as expense comes first. The debits always come first. Posted, posting reference, cash, credited, posting reference, posting reference. Let's see. We provide consulting services on credit, so we provide $1,600 worth of rent. Oh, I'm sorry. We provide consulting services of $1,600, and we rent our facilities to someone for $300. So he's billed for $1,900. So accounts receivable and asset is going to be increased by the whole amount, $1,900. And the consulting revenue is going to be credited, increased by $1,600, and rent revenue is going to be increased by $300. So we got 3 accounts. But notice, $1,900 on the debit side, $1,900 on the credit side. Accounts receivable debited for $1,900, post reference. Consulting revenue is credited for $1,600, post reference. Rental revenue is credited for $300. Notice the post references again. Again, revenue is recognized when the products or services are provided, not when they pay. And this is a compound entry, which means it affects more than 2 accounts. But you notice, debits always come first. Debited accounts always come first, followed by all the credits. We received cash from accounts receivable. Somebody paid us something we'd already billed them, so we don't have to bill them again. We're just going to take it out of accounts receivable. Cash is increased, accounts receivable is decreased. Cash and accounts receivable are both assets, so cash will be debited, increased. Accounts receivable will be credited, decreased. Cash, debit of $1,900 in the journal, accounts receivable credit of $1,900 in the journal, post the $1,900 debit to cash, post the $1,900 credit to accounts receivable. As you can see here, if you came up with a balance of accounts receivable at this moment, accounts receivable would have a zero balance. If you came up with a balance in cash, it would be something different. I want to show you how a T account would look for me. Let's see if I can get there. Oh, it doesn't want to do it. Hang on a second. Here's a T account for cash. And you notice that I've put everything on its own line. It just makes it much easier to see. Cash has a $30,000 entry for entry number 1, a $2,500 credit for entry 2, $26,000 for 3, $4,200 for as a debit for on number 5. Number 4 didn't affect cash. Account entry number 6 was a credit to cash. Entry number 7 was a credit to cash, and entry number 9 was a debit to cash. So I want the balance. So what I'm going to do is I want the sum of all this minus the sum of all this, and the balance is $5,900. $30,000 plus $4,200 plus $1,900 minus $2,500 minus $26,000 minus $1,000 minus $700. Let's see if my equation works out. Yeah, if you want to do that, we can just do just add up the debit side, add up the credit side, and subtract the two just to be sure. $5,900. So my balance in cash, if I were to want a balance, I would just draw a line right there. Where I want that, put a big line there, and then I would say balance. There we go. That's what it would look like, something like that. Okay, back to there. Okay, we paid $900 cash towards accounts payable in transaction 4. Cash is decreased, also accounts payable is decreased. We don't have to record the expense again or the purchase of supplies or whatever. We are going to do, record it as a debit to accounts payable. Now in this case, liability accounts are decreased by debits, and we're decreasing accounts payable here, so we're going to debit accounts payable. Cash is an asset decreased by credits. We're going to decrease it by crediting that account. Enter it in the journal, debit to accounts payable. We don't put the posting reference in here until we already post it. $900 debit to that account. Now we put the posting references in. Cash is the same way. We put $900 in the credit side of cash. Decreases both accounts, and didn't do my posting references. We paid a $200 cash dividend. Cash went down, dividends went up, but that decreases equity. So dividends are increased by debit, so we debit dividends, we credit cash in the journal, we post to the ledger, and record our posting references. Here we have another couple of things we talk about. Let's see, we received $3,000 in advance of providing consulting services to a customer. So we received the money, cash went up, but we haven't earned the money yet. So that is unearned revenue. Remember, that's a liability. So we're going to debit cash for the $3,000 they paid us. We're going to credit the liability account by $3,000 for the money they paid us. If we don't perform our part of the contract, we have to return that. That's why it's a credit, a liability. We put our posting references in, account numbers in the journal, and the date, or in this case, a transaction number in the ledger. Now we paid something ahead of time. Somebody paid us, now we're paying somebody else. We paid $2,400 for a 24-month insurance policy. Coverage began on December the 1st, and we paid $2,400 in cash, and it went to a prepaid asset. This is an asset that we're going to draw on for the next 24 months. So we're going to debit the prepaid insurance, the asset account. We're going to credit cash, the asset account. So one asset goes up, one asset goes down. Debit the prepaid expense account, posting references everywhere. Credit the cash account, posting references everywhere. We paid $120 cash for supplies. Simple, we've done this before. Cash is going to be decreased. Supplies are going to be increased. Two assets. Debit supplies, $120. Credit cash, $120. Posting references. We paid an expense in cash. We paid $305 for utilities expense. This is going to be a credit to cash and a debit to expense. So expenses, remember, are increased by debits, even though they're in the equity section. Utilities expense in the journal, debit, $305. Cash in the journal, $305. Credit. Posting references. Don't forget the posting references. We paid another expense, $700 for employee salary. Cash is going to be credited. A salary expense is going to be debited. So in the salary expense account, you see the other debit. And in the cash account, you see the $700 credit. And you see cash is getting a lot of work. Debits and credits, debits and credits, debits and credits. And that is why I say it's a much easier thing to see if you have these all in order here. Just be aware the book doesn't really do that for you much. Here's another little opportunity to see the normal balances and the increase. You notice that assets are increased by debits, decreased by credits, as are dividends and expenses. Liabilities, common stock, revenue are increased by credits, decreased by debits. You think of retained earnings being increased by credits, decreased by debits. However, retained earnings could flip and have a debit balance. If it did, I would probably put parentheses around it. Yep, that balance there. So here we have, instead of having a spreadsheet, these are the T accounts, or think of them as those ledger accounts that we had that we did before with the different columns, the date, the description, which you don't use much, debit and credit transaction, and then the column, the balance column. So at the end of every transaction in a regular ledger account, you would have the balance, but we don't have that. So we have to actually draw a line, add up the debits, add up the credits, put the balance on the side that has the most money in it. And you'll notice here, all the asset accounts have a debit balance. There's no credit balances here. Liability accounts all have credit balances. Common stock, credit balance. Revenue, credit balance. Rental revenue, credit balance. Dividends and expenses all have debit balances, just like this little chart up here tells us. Just like that little chart tells us. But we know our balances now. We can take these numbers, $42.75 for cash, $92.70 for supplies, $2,400 for prepaid expense, and $26,000 for equipment, and add them up to get our totals here. We can do the same thing for liabilities and for revenues, expenses, common stock, and dividends, and get the totals here. If you add these two up, you're going to get $42,395, because assets equals liabilities plus equity. They mentioned big data here, and I've mentioned in class that you'll have not dozens of transactions in a month. You'll have thousands, hundreds of thousands, millions, depending on the size of the company. Not unusual to have thousands of transactions in a fairly small company. But big data is different than other data sets due to the volume that it generates, the velocity, the speed at which these things happen. The transactions are occurring so rapidly. And variety means there's so many different types of things. So we use artificial intelligence to help find trends and problems that we would have trouble recognizing in something that's such a huge data set. So just be aware it's a tool, it's not a replacement. If you're using it to replace your understanding in your homework, you're going to be out of luck when it comes to the job market. Students who spend a lot of time letting AI be their homework slave end up getting fired shortly after getting hired. That's the true story there on that one. This is a good need to know thing to do. Watch the video and see how things go. And this is a really good one here. I like it. Okay, I'm going to end with that for now. We'll do another video for the rest of the chapter, but this is the biggest part of it.